Higher Fed rates make financing your home, your car, and credit card purchases more expensive, but they also mean greater earnings for savers. CNBC senior personal finance correspondent Sharon Epperson joins us right now with some key money moves to make right now. And Sharon, for savers, it's like finally,
I know, finally something to celebrate. But the Fed's latest rate hike does add more fuel to a series of rate increases that is impacting borrowing costs. According to Bankrate, the 30-year fixed-rate mortgage is now nearly 7%. New car loan rates are over 7%, and the average annual percentage rate on a credit card is just above 20%, a record high that's forcing many consumers to carry higher balances. Now, refinancing your mortgage or a car loan may be tough given where rates are right now, but there are some key moves to make to deal with credit card debt. Ideally, of course, you want to pay off credit card balances to avoid any interest on debt, but if you can't swing that, then request a lower rate or an APR. If you don't ask, you're not going to get it. So call your card issuer. Also consider opening a 0% interest balance transfer card. You won't have to pay interest for 18 months, maybe even more, but you'll need to figure out whether moving an existing balance to this card is worth the 3 to 5% transfer fee. Now, there are some silver linings, like we talked about, to the Fed's series of rate hikes, allowing savers to take advantage of rising rates. Top rates on high-yield savings accounts at online banks are now over 5% and close to 5.5% for CDs. Even in a rising rate environment, though, many financial advisors say contributing as much as possible to workplace retirement plans makes sense. The maximum 401k contribution is $22,500 this year, and with a $7,500 catch-up contribution, if you're 50 or older, you could stash away up to $30,000. Advisors also say that mid-year is a good time to review investment choices, rebalance, make sure you're on track to meet your goals for the rest of 2023 and beyond.
All right, so why is mid-year the time to start looking through some of these retirement accounts, some of your personal finances on these things? I always think of it doing it like January.
Exactly, but I think some people are just on autopilot, right? And so they've done the same thing with their 401k perhaps the year before. Maybe they did look at it in January. Maybe they didn't realize that their company has a Roth 401k option, that they could have some after-tax money going into their retirement account, so they might want to look into that. And then when it comes to other things that you may want to recalibrate, even your take-home pay, looking at your withholding, mid-year is a pretty good thing, so then you're not surprised come next April when you either get a big refund or you owe. So those are a couple of things that you can do. And then plan for upcoming expenses now, because for those people who are going to have those student loan payments that they're going to have to pay in the fall, now's the time to kind of look at, how am I going to do that? Let me start making payments to myself to pretend that I'm paying that bill.
All good advice.
Yeah.
Sharon, thank you.